Everything looked fine until the chart started bleeding. One red candle, then another, and before anyone noticed, the market flipped. Buyers vanished. Fear took over. This isn't just a dip. This is the start of a downtrend. And if you're not prepared, it will wipe you out. Understanding downtrends in trading. A downtrend is defined by a series of lower highs and lower lows, forming a distinct downward pattern. This movement signals a market where sellers dominate, continuously driving prices lower. Key characteristics of a downtrend. Impulse moves, strong downward movement. Sharp price drops marked by strong bearish candlesticks. Each impulse move sets a new lower low, confirming bearish momentum. Corrective moves, temporary upward retracement, weaker price movements against the main trend. Consist of small or dull candlesticks, forming minor price increases, often occur due to profit taking from earlier short positions. Confirming a downtrend. A true downtrend requires at least 2 impulse moves and 2 corrective moves, showing a consistent pattern of lower highs and lower lows. Identifying downtrends with trend lines. 1. Marking lower highs, identify and plot the swing highs, lower highs on the chart. 2. Drawing the trend line. Connect all the lower highs to form a downward sloping resistance line. This trend line serves as a reference for potential short entries when the price retests it. 3. Drawing the trend channel. Identify and connect lower lows with a parallel support line. This lower boundary acts as a support zone where traders may look for temporary buy opportunities during corrective moves. How to trade a downtrend, no indicators needed. Wait for a pullback to a lower high. Don't chase price when it's dropping fast. Instead, wait for a weak corrective move that pulls back to a resistance level, previous support turned resistance, or trend line. Look for rejection at the resistance. When price approaches the trend line or a previous lower high, observe the candlesticks. Signs of rejection include wicks to the upside, bearish engulfing patterns, or consecutive small-bodied candles. Enter a short trade. Once the price shows rejection at resistance, enter a sell trade. Your stop loss should be placed slightly above the previous lower high. Target the next lower low. Set a take profit at the next expected lower low, previous support level. If the trend is strong, you can trail your stop loss above each new lower high to maximize profits. Exit. When the trend shows signs of reversal, a downtrend is weakening if price fails to make a new lower low or breaks above a lower high. If this happens, consider closing the trade or tightening your stop loss. Key insights for trading downtrends. Impulse moves are strong and define the trend direction. Corrective moves are weaker and often result from profit taking. Trading in the direction of the impulse move increases profit potential. A downtrend reverses when the market fails to form new lower highs and starts breaking resistance, signaling a transition to sideways or upward movement. By mastering these concepts, traders can confidently identify, enter, and manage trades in a downtrend without relying on indicators. When the market falls, most panic. But the smart ones, they prepare, they adapt, they profit. Don't just watch the crash, learn to trade it. If this hit home, hit that like button, subscribe for more no BS market breakdowns, and I'll see you in the next one before the next candle drops.